let's remind you of what Jerome Powell's big goal is, and actually one I don't think he is talking about. Let's talk about trueflation. Let's actually talk about my greatest fear for the real estate market. Folks, let's get into it. Let's start with inflation. We obviously got a CPI reading yesterday. Headline, core, month on month, year on year, all higher than expected. Bonds, I'm sure, ripped. Stock market had a horrible day. But let's look behind the numbers and then let's talk about trueflation. So when you look behind the numbers, you can really see there were services increases. Again, folks, remember, the economy is made up of stuff and services. We have undoubtedly seen the easy part of stuff, aka cardboard boxes and things of that nature, roll over. But what we saw in services was somewhat alarming. Now, there is a chance that this was just a one-time January effect, but again, we need to watch this. For example, motor vehicle insurance, up 20%. Repair for household items, up 18%. Sporting events, up 13%. And of course, the one that you and I watch most frequently, shelter, up 6%. Now, let's step back. We do have to watch the services component because, again, the largest contributor to services is wages. So we need to watch this. Is it becoming sticky? Are we seeing companies roll through what was a couple years of inflation? This could be a problem. This could be a, reignition of stubborn and high inflation. It also could boil down to, hey, January price hikes, they're all over. So we're going to have to pay attention going forward. But if you watch this channel, you've heard me talk about trueflation a couple of times. I would argue that you should go there and really understand what trueflation is. Trueflation, unlike CPI, which had 3.4 yesterday, that was what was reported for headline, or no, core. Yeah, core. Trueflation shows 1.39. What is the difference? Trueflation is trying to update the inflation calculation daily. It does not use lagging indicators. So we have to ask ourselves, or at least I ask myself, does Powell see all of this? And I think the answer is, of course, absolutely. There's likely not any economic data that he doesn't have available or doesn't consume at some level. So I think Powell knows that the real-time updating of the economy and inflation is lower than their convoluted, backward-looking, lagging CPI indication. But remember, over a year ago, when Powell was at Jackson Hole, remember that Jackson Hole speech? It might have been 15 months ago. I tried to highlight an important concept that I think Powell was going after. And we haven't talked about it, but I still think it is his true goal. I believe Jerome Powell wants to go down in the history books for breaking the Fed put. Janet Yellen, Greenspan, Bernanke, all could be yanked around by Wall Street and deep money to bail them out of bad bets. It is my hope and expectation that Jerome Powell is staying on this mission and that he will let pain occur, specifically in, obviously, the commercial banking sector, right? Mortgages, things of that nature. But we shall see. There are certainly indications, if you wanted to read them that way, that a bailout could be coming. Think bank term funding program for treasuries, something like that could happen. I would not be a fan, but It could happen. But again, I think this is a sign that Powell will use anything he can to keep rates higher for longer. Okay, now let's switch to the market. Remember the market. The market has been like a spoiled little kid. It's been whining and crying and all of these things, basically begging the Fed for, at one point, 7 rate cuts. So what are the rate cuts as of this morning? I want to shout out Taylor from Life Goal Investments. He sent me the link. As of right now, the chance of a March rate cut is 8.5%. So we have gone from 80 to 8. I would say March is dead and gone, but hey. How about May? I think with the high inflation reading, you should be writing off May and maybe looking at June, but what does the market say? The market says 34%. Okay. How about June? That's the month that I've been calling for 6 months now. The market right now prices in the first rate cut in June of 75%. All right, just to keep it going, what about July? July has the first rate cut odds, or a rate cut in July at 91%. And then finally, as far as I went, was September. September currently prices in 98% chance of a rate cut by September. So again, higher for longer makes sense. Again, no March rate cut. I don't know how you have a March rate cut with inflation up, or at least higher than expected, and a strong job market, so hopefully that is gone. We definitely have to watch inflation from the services side, because that is the largest part of our economy and really was the cause for yesterday's reading. Next, I was interviewed yesterday on a podcast and actually asked a question I have never been asked before. If you actually get the video, you will actually see me pause for 20 seconds or so, because I wanted to give a thoughtful answer. And I want to ask you, I want to give you the same question, and I would love you to put the comments below. Here was the question. The question was, what is your greatest fear about the housing or real estate market? What is your greatest fear about the housing or real estate market? Please let me know what your thoughts are below. I would love to read your comments. I'll give you mine. I'll give you mine right now, just so I don't forget later. Sometimes I forget things. For me, what I came back with after 20 seconds was Renter Nation. I believe if we saw the U.S. Economy or U.S. system with below 50% home ownership, and we flip from 64, 65, whatever it is, to sub 50, that Renter Nation is my greatest fear. I believe homeownership is the path to a better future for most individuals. It is their greatest asset at retirement. It is the only thing that allowed my mother to have a decent retirement, was because of her home in the Silicon Valley, bought in the 70s. So again, I'm a big believer in getting on the property ladder, house hacking, however you have to do that. So that's my greatest fear. I would love to hear your greatest fear. Don't know if you saw this, but Resi Club put out a very interesting article yesterday talking about the top 25 markets for Airbnb and short-term rentals. Now, you can go ahead and get the article at resiclubanalytics.com. For me, I only took the top 5. I took the top 5 markets, and I don't know. Have I heard of any of these? I've heard a couple of these. So let me know what you think. Number 1, Columbus, Georgia. Number 2, Ellsworth, Maine. Number 3, Logan, Ohio. Number 4, Spring Hill, Florida. And then finally, number 5, Sneads Ferry, North Carolina. Again, I personally am not a fan of short-term rentals. I don't need another job. I don't need to be in the hospitality business, but who cares what I think? Lots of folks are interested, so there you go. Top 5 markets. If you want the top 25, go to ResiClubAnalytics.com. It is, I believe, a free article, so you can go get it there. I want to talk about some housing data because apparently I failed to list it yesterday, so I just want to hit it again. Active listings, this would have been as of Monday, I believe. Active listings are down 0.5% month on month, but they are up. They are up 12% year on year. So again, I think I like year on year numbers better than month on month. So again, year on year, active listings are up 12%. Month on month, they are again down 0.5. So what is going on? Do we have the lock-in effect loosening? Is the move-up buyer going? I don't know. This is why we look at the data every week. Shout out Logan and Mike for putting that data on Twitter or X. Let's talk about mortgage apps. Every Wednesday we get mortgage app information, both refi and purchase. Shocking, folks, rates matter. We've obviously seen rates tick up the last week or so, and purchase apps fell 3% and down 12% year on year. So a lot of stuff going on there. Let's talk about some earnings. We got Airbnb. Airbnb beat top line, beat bottom line, raised guidance. Uber, same deal, double beat, and announced a $7 billion stock buyback. Zillow, wow, Zillow beat top line, beat bottom line. Robinhood beat top line, beat bottom line. Lyft, even good old Lyft, matched revenue, beat earnings. Don't know if you guys saw what happened to Lyft, but apparently somebody in their financial organization is going to get fired. Yes, folks, during their press release about their earnings, which are meant to be rosy, someone fat-fingered a decimal. They were supposed to highlight that their gross margin percentage went up 0.5%, like 0.5. Instead, it read 5%. And the market ripped in after hours, only to have the CFO in the earnings call publicly issue a mea culpa and highlight the mistake. Somebody lost their job, no question. Lastly, let's talk about 08. There are still the folks out there that believe we are entering the Great Recession on repeat. I want to remind you that the setup is just different. I was buying, I was active during 02, 03, 04, 05. A lot of these folks are just living in their mom's basement. So let me remind you that the step one of the 08 to 2012 crash was 4 years of continuously worse and worse underwriting. We had 4 years where every year got worse. The loan quality got worse. So we had 4 years of credit, destruction. Number two, I don't know why people don't understand this. The data is out there. You can Google this. Roughly 50% of the loans originated in 2006 were adjustable rate mortgages. I think it was 12, it might have been 14% of them were the toxic pick-a-payment negative equity loans. Now these loans did okay for 2 years until they started to blow up. Folks, I don't know why you don't understand this, and I don't know. But today, the debt is an asset. If you have a 2.8% mortgage and you lose your job, you can sell the house some way, somehow. In 2006, your 2% mortgage went to 11, and you couldn't sell your home because there was no equity and the debt was toxic. And then lastly, after 4 years of horrible credit expansion, horrible loan origination stats around ARMs, we had a nasty 18-month recession. I have been calling for a recession for quite a while and frankly been wrong. I don't think anyone out there is calling for a Great Recession 2.0. So we don't have the same setup. It is just not the same. And lastly, I want to close with kind of a gift and also a selfish ask. I'm going to frame this as a gift, but let's be clear, this is completely selfish. If you watched my video over the weekend talking about my goals, you will know that I sold 0 courses last week. That has continued to today. So it's 10 or 11 days. I think something might be broken on Teachable because I've been doing this for 5 years, and to go 11 days in a row without a sale is unheard of. So what I want to do today for Valentine's Day, see, it's very selfish, and I'm framing it as a Valentine's Day gift. It is what it is. I'm going to do a buy one, get one. So if you buy a $50 course like Dan Bird's Stocks or Buy Box or Debt Equity, you can get another one. If you buy the main course, How to Get Started One Rental at a Time at $3.99, I will allow you to gift it to someone else. If you buy the 10-week boot camp, I will allow you to gift another one to someone else. I am hoping that at least one person buys a course today that I will then validate that the system is not broken. At the end of the day, buy one, get one. Never done it before, won't do it again. I'm framing it as a Valentine's Day gift for you, but in reality, it is completely selfish. I want to make sure the system's not broken, and there you go. How's that for direct and honesty? So at the end of the day, folks, I will see you Friday if you're in Vegas for Ryan Pineda's 2-hour event. And of course, the big event Saturday and Sunday. I'm going to probably shut down the virtual tickets today because I want one less thing to worry about. So if you want to get the virtual ticket, today's your last chance. $99, sign up. The system will email you Saturday morning, email you Sunday, and we should be good to go. So have a wonderful day. Take care of yourself. Bye.